Hello everyone, thanks for checking out my video. Last week was a mixed week for the US stock market. The S&P 500 had ended its 3-week winning streak, while the Dow Jones posted a decline for the second consecutive week as it fell for a 7th session last Friday, its longest run of losses since 2020. However, the tech-heavy Nasdaq continued to push higher with its very own 4-week winning streak as it hit the milestone 20,000 points for the first time ever in history. It appears to me that the market sentiment is a little mixed and cautious ahead of the upcoming highly anticipated Federal Reserve policy meeting. This meeting has become even more significant after last week's 2 inflation data gave us conflicting information. Alright, without further ado, let's cover some of this in detail, and as always, do watch throughout the video to find out more. So, the Wall Street's rally stalled a little bit last week amid mixed inflation reports. Inflation rates have been warming up slightly over the past few months. The latest CPI figures showed an increase of 2.7% in November, up from October's 2.6%. The market did not decline much when the report was out because the figure was in line with expectation. However, that number, to me, is a reminder that inflation remains sticky and stubborn. Then came the PPI report, which showed an increase of 0.4% for November, higher than the estimate of 0.2%. On an annual basis, PPI rose 3%, and this is the biggest increment since February 2023. These numbers might have been a bit uncomfortable for the market to handle, and as a result, the market retreated when the PPI report came out. Just to add on, as of the date of recording, all 3 key inflation indicators CPI, PCE and PPI are back on the rise, which means the Federal Reserve's job to bring inflation down to their 2% target is far from done yet. Okay, but with all that being said, the market is still fully expecting the Fed to cut interest rate for the upcoming FOMC meeting, scheduled to take place on 17 and 18 December. This expectation is tracked by this CME Fed Watch tool, which shows a 95% probability of a 25 basis point cut this month. Since the rate cut is widely expected to happen, the market might be more interested in the plans for future cuts, because that is still pretty much more up in the air. Investors, including myself, would be looking for insights from Jerome Powell's press conference on 18 December to see how he and his team are digesting the recent economic data showing stubborn inflation and a resilient labor market. To wrap up the upcoming week, the Fed's preferred measure of inflation, which is the PCE index, will be released on Friday 20th December. The market consensus is a 2.5% rise in November, up from 2.3% in October. Let's see if we get any upside surprise from this report. If so, then just like the PPI report, I think the market might not like it. Okay, let's now read some technical charts. As usual, we shall begin things off with SPY. So in my previous video, I shared that we should watch this 609 resistance level. Well, this level has once again proven to be a strong resistance point, as SPY went near it 3 times last week but struggled to break above it. For this week, it's gonna be the same. Watch this 609 level again, which is actually the 78.6 Fibonacci extension level. If SPY can cross it with decent volume by the end of the week, then we could be in for a center rally that could last till early January 2025. On the other hand, if SPY continues to struggle to get above 609, watch for 599 to 600 as a support area, formed by the first Fibonacci retracement level and the psychological 600 milestone level. Here's the good news for the bulls. Despite last week's retracement and a bearish cross on the MACD, SPY did not even fall below this 599-600 area. That, to me, is a good sign, as it means the bears were never in control at all. It was just a bit of profit taking in the market. That being said, if somehow this support area breaks this week, then pay a bit more attention to the market movement. It could be a chance for long-term investors to step in to pick up shares. Not financial advice, of course. The wildcard for this coming week is none other than the FOMC meeting and probably the release of PCE index. My personal view is that even if the market reacts negatively to both events, as long as SPY doesn't fall below that 50% Fibonacci retracement level, which sits at around 588, it's all good. The year-end rally is still on. Alright, let's hop over to Apple's chart. Wow, 17 green candlesticks in the last 22 trading days and a new all-time high of 250.8. Just how bullish can Apple get? Well, in my last video, I shared that above 244 and at record high, the sky is the limit due to it being uncharted territory. True enough, the moment Apple punched above 244 last Monday, it did not look back as it continued to climb higher throughout the week. For this week, it's the same theory for the bullish thesis. If Apple goes above 250.8 and create another new all-time high, it is just gonna go higher till God knows when will big institutions start taking profits. But if you were to ask me, I don't think Apple will move too crazily to the upside this week, or at least for the early half of the week, as the market anticipates Jerome Powell's press conference on Wednesday. Another reason why I think Apple will not rocket too much this week because the RSI is already at the overbought level. It needs a bit of breather. But honestly, who knows, it could be a case where Apple retraces early in the week to cool off the RSI before surging to all-time high later in the week. Anyway, whichever the case, I'm not here to predict the market movement. So if we have a retracement this week, watch for 243 as the first support level. But even if this breaks, the bulls don't have to panic yet. The more important support level is that blue line that I have drawn at around 236. This level used to be a strong resistance level in the past, but since Apple has climbed above it, it has now turned into a decent support level. Okay, let's now check out this monster Tesla. Honestly, I don't know what are the best terms to describe Tesla right now. A monster, a beast, defying gravity, melt up, short squeeze. Maybe a combination of all these terms. Basically, buyers of Tesla shares are too overwhelming at the moment. It could be driven by FOMO investors or shorts covering their positions, or both. Whichever it is, it usually will cause a melt up in the share price, which is what we are seeing right now. Such melt-up will eventually fade off when FOMO investors and shorts are done stepping up the shares that they need. Only question is we don't know when. This is why we look for key support and resistance levels in this technical analysis segment to try to anticipate as much as we can. Anyway, when I said that melt-up will eventually end, it doesn't mean that Tesla will fall from here. There is still some room to run up. So in terms of the bullish thesis, I know you probably can't see on the screen, but the next resistance level is the 100% Fibonacci extension level at around 456. As long as Tesla remains above the 71.8 Fibonacci level at 424, then Tesla has a chance to hit 450's range before they announce their quarterly and 2024's total delivery numbers, which usually takes place at the start of the new year. On the other hand, in terms of the bearish thesis, again, I'm not trying to scare you, but I just wanna say when Tesla wants to flush now, it can flush really quickly and the drop can be huge. From the current level, the first support level we can watch out for is this psychological 400 level. I would think a lot of FOMO investors step in above this level, and if the big whales want to dump Tesla shares for whichever reasons, then this 400 will likely get breached, and a lot of FOMO investors will be left back holding the shares for a while. Below 400, don't be surprised if it flushes down to 383 or even 350. Those are the Fibonacci retracement levels which will act as support. In my opinion, the more important level lies at 324 where the 50% Fibonacci retracement level is. If Tesla ever reaches here in the short term and doesn't bounce from this level, it simply spells trouble. But with all this being said, I think from now till year end, it's quite unlikely that Tesla will fall that much. The next potential huge movement will likely come around early January when Tesla announces their delivery numbers. Last of all, I just wanted to zoom out the chart and show you this. On the RSI, the last few times when the indicator hit the current level or was near this level were November 2024, July 2024, June 2023, and January 2023. Each time, soon after it hits such overbought level, the share price will go up a little bit more and then retrace quite significantly. So in January 2023, the peak to bottom was a 24% plunge from 217 to around 164, and it took 2 months to play out. In June 2023, it was about 29% decline in a month, from the peak of around 299 to the bottom of around 212. Then in July 2024, it fell from 271 to 182, and that was a whopping 32% drop in less than a month. And then we have the most recent one in November 2024, which is also the mildest one. Basically, Tesla dropped from around 358 to about 309, which was close to 14% decline. But it's worth highlighting that this drop happened in just 4 days. So what's my point? My point here is, sure, Tesla still has room to go up, but as it goes further up, be very careful that a rug pull may happen before it climbs up again. In the long run, I am definitely still bullish about the company, but come January 2025, I will be a little cautious ahead of its delivery numbers as well as their earnings report. Okay, let's now move over to Google's chart. Similar to Tesla, Google looks a little extended as the RSI hit the overbought level. But unlike Tesla, which didn't really pull back, Google has started its retracement, which has helped to cool off the indicator by a little bit. For the bullish momentum to continue, Google needs to get above 191 again, where the 78.6 Fibonacci extension level is. The longer we stay above this level, the higher chance we hit another all-time high, because the next Fibonacci extension resistance level is at around 199. And if we ever hit 199 in the next 2 weeks, I think sellers will likely dry up, and FOMO investors will probably push it above the 200 milestone level, just like how the bulls brought Tesla across the 400 level. It's the same theory. Okay, on the other hand, just wanted to highlight that the recent pop in Google's share price was a result of their new quantum computing chip. And if you have been following me, you will know that such news-driven rally is not sustainable, at least in the short term. So if the pullback continues this week, watch out for 184 as the first Fibonacci retracement support level. If this gets breached, I would think there is a high probability that a huge gap up will be filled. This gap is between 176 to 181. Even if it doesn't get filled entirely, I can expect Google to hit this range if 184 is breached. All in all, there is nothing to be too worried about so long as the bulls can defend 171. This 171 is a decent support level formed by the 50% Fibonacci level and the 50 moving average. Okay, moving over to Meta's chart. In my last video, I shared that it will be quite difficult for Meta to go above 635, and I also mentioned that at around 630's range, we could see sellers stepping in. Well, Meta actually went above 635 but did not manage to close above this level, and then, true enough, sellers really stepped in at 630's range. For this coming week, if the pullback continues, we can expect Meta to hit 604 at least. This level used to be a resistance level, but have turned into a support. If this breaks, then I think there is a high probability for Meta to hit towards 583, where the next Fibonacci level and the 50 moving average are. Well, if you were to ask me, I will not be too bothered by any form of pullback so long as Meta stays above that blue dotted downtrend channel. Any pullback above this channel is healthy in my opinion. Okay, as for the upside, first of all, it needs to reclaim the 633 Fibonacci extension level. Above that, obviously, the all-time high of 638 would be the target. If we can push above 638, the next Fibonacci extension resistance level lies at around 657. Once again, like I always said, at all-time high, we really don't know when will the big institutions start taking profits. So don't go about thinking that above 638 is a sure thing that Meta will hit 657. I mean, I think it eventually will hit that level in the long run, but it's difficult to predict the price movement in the next 2 weeks. Well, whether Meta hits 650's range or drop back to low 600's range, I think it's quite dependent on how the market reacts to the FOMC meeting and Friday's PCE index. Moving on, let's have a look at Microsoft's chart. If you have been following me, you would probably know how I have been slicing the chart up using that blue uptrend line. Above it, it's bullish, and below it, it's bearish. Okay, I know that's not a new thing since I have been sharing it. Let me now share something new with you. Can you see that candlestick from last Thursday on 12th December? That's called a doji gravestone candlestick, which is bearish. How we interpret this candlestick is that the bulls attempted to push the share price higher during intraday, but the bears took over control later in the day and brought the price down to near the opening by the closing hour. And the long upper shadow represents the bulls losing momentum. The bearish momentum was confirmed by the next candle as it closes below the closing price of the gravestone doji candlestick. So anyway, if the pullback continues this week, I personally will ignore the first Fibonacci retracement level at 444. Because if the bears are really back, I think they will minimally target the 38.2 Fibonacci level at around 437. That's also where the blue uptrend line is, so watch this 436-437 level closely. If this level breaks, we may likely head towards 430 where the next support level is. At this 430 level, don't be surprised if bears bring it further down to the high 420s range. Okay, on the other hand, if Microsoft somehow invalidates that bearish candlestick, I wouldn't be surprised if it does that because 1 to 2 candlesticks don't shape a trend. So let's say Microsoft resumes its bullish momentum, then it could potentially bounce off the first Fibonacci level at 444 and go back up. A break above 456 after the FOMC meeting could give us a high probability of grinding towards the all-time high at 466. Well, if you can ride the uptrend from the high 450s to a new all-time high probably close to 470, whether is it through options trading or normal share price trading, you could potentially earn decent profits. Not financial advice, of course. Alright, let's now jump over to Nvidia's chart. If you could recall, I specifically mentioned in my last video that it takes a lot to go against this hottest stock in town, but I was being objective by sharing what I saw on the chart. And so I said that unlike other big tech charts that displayed bullish momentum, Nvidia was the opposite. You can check out my last video if you want, and guess what? Nvidia fell more than 3% last week. Okay, for this week, what should we look out for? Well, sorry, I had to bring back my last video's analysis again, which is when that 138 support level breaks, Nvidia could hit 120's range. Honestly, I think this thesis is still valid, especially when we had that bearish engulfing candle formed last Friday. But I don't know why, but it seems like there is this invisible support level at around 132. Nvidia actually tested this level 3 times in the last 1.5 months and did not fall below it, which then makes this level quite important. Therefore, come this week, if 132 breaks, then perhaps it's really time for us to see Nvidia in the 120s range again. Anyway, if Nvidia really falls towards the 120s range this or next week, there is no need to panic yet. However, the bulls should panic a little bit, just a little bit, if Nvidia falls below 121. And they should panic big time if 114 or 115 area breaks, because that's where the 200 moving average and the critical 61.8 Fibonacci level are. But then on second thought, instead of panicking, below 115 should get you and me excited because that could be a chance for us to pick up shares at discounted price. From its peak of 152.89 to 115, that's a close to 25% discount, which actually is equivalent to a crash in the share price. Will Nvidia get there before the year ends? Honestly, I don't know. I do wish it does. Let's see what the FOMC meeting has for us and how the market reacts to it. That's probably the only foreseeable catalyst before the year ends. Let's now jump over to the options trading section. 2 new trades to update this week. And first one is this cash secure put on Tesla, which was sold last Monday, 9 December. The strike price is $3.15 and the contract will expire on 27 December. The reason for selling this contract is quite unconventional. It is actually because I wanted to earn a small premium for the holiday season. So what happened was on 9 December, Tesla was going near the huge $400 level. The momentum looked strong and I knew Tesla bulls and FOMO investors will very likely bring Tesla past that milestone. With that, I thought, why not just sell a put contract and earn like $100 for my Christmas or New Year's dinner? That was why I chose the expiration date as 27 December before the year ends. Another reason is because the next expiration date is 3rd January 2025, and that's the period where Tesla will announce their quarterly and full year delivery numbers, and you will never know how will the share price react to these numbers. Anyway, Tesla really went on to break above 400 in the next few days after I sold my put contract, and even reached a new all-time high of 436. From the current price, as long as Tesla doesn't crash more than 27% these 2 weeks, this contract should expire worthless, and I should be able to keep the $113 premium for my festive celebration. That's equivalent to around 150 Singapore dollars. Not too bad, right? Okay, next up it's this new cash secured put on Nvidia, which was sold last Friday 13 December. The strike price is 115 and the contract will expire 17 January 2025. The reason for selling this put contract, which is a slightly bullish move, is because I am anticipating a small bounce or sideways movement in Nvidia in the near term. As you can see from the chart, Nvidia has declined quite a fair bit recently from 152 to around 134, and the RSI is approaching oversold soon. Well, I could have waited for a while more for the RSI to really hit the oversold zone to increase my probability of winning. But knowing that we are in a strong bull market and that the last 2 weeks of December is typically a strong period for the stock market, Nvidia may not reach that oversold level. Therefore, I decided to step in earlier. That said, to manage my risk, I gave myself some buffer by choosing a lower strike price at 115. This strike price is roughly where the critical 61.8 Fibonacci level is, as well as where the strong 200 moving average support sits, forming a double support level. And if the overall bull market is to continue into early next year, the 50% Fibonacci level is also one potential good support area where Nvidia could rebound, and that level is 121. Last but not least, last week's decline in Nvidia's share price was likely a result of this negative news, where it was reported that China is launching an antitrust probe into the company. After the news came out on 12 December, Nvidia fell more than 3.5% in 2 days. And if you have been following me, you would know that I like to step in whenever there is such negative news that weighs the share price down, because once the knee-jerk reaction is over, the share price will typically move either sideways or have a short-term rebound. Alright, so the US stock market is widely expecting another rate cut by the Fed for the week ahead. Some investors, including myself, are categorizing this cut as a hawkish cut. In other words, the Fed will be a bit more cautious after this latest round of rate cut as we enter 2025. Reason being, the series of mixed data in recent weeks and months has more or less proven that inflation is stubborn and sticky, which I have shared in a number of my videos. The Fed's battle against inflation is far from over because sticky inflation could revive fears of prolonged monetary tightening in 2025. To add on, the incoming President Donald Trump's tariffs would be an economic wildcard that could affect the Fed's monetary policy. Therefore, it would be more prudent for the Fed to tread carefully and re-evaluate the interest rate trajectory for next year. Basically, the interest rates need to be high enough to cause inflation to slowly decline to the Fed's target level of 2%, yet they should not be so high as to cause damage to the labor market. Well, I must say this is a delicate balancing act. Anyway, the Fed will be releasing new forecasts and rate projections on the second day of their FOMC meeting, which means on 18 December, Wednesday. If both Powell and the rate projections appear to be very hawkish, the market might not like it, and we could have a bit of retracement. If that happens, don't panic yet. The overall bull run and primary market uptrend are still very much intact from now till early 2025, barring any black swan events these 2 weeks, which means any form of pullback resulted from the FOMC meeting could be an opportunity to pick up shares at discounted prices. On the other hand, if the FOMC meeting and the upcoming PCE index could not even bring the market down a little bit, then a potential center rally could possibly bring S&P 500's year-to-date return from the current 27.5% to maybe 30%. But just a quick caveat, this is not a prediction. I'm just saying, putting aside any unknown circumstances, I don't see much known negative catalysts or obstacles in the way from now till early January 2025, once we get past the FOMC meeting and PCE index this week. Well, I could be wrong, let's see. Okay, that's all for this video. I hope you have stayed invested throughout the year and is enjoying this bull run as much as I do. Let's see if I have some time to do a special edition video as we approach the end of the year, such as a quick review of my portfolio or my options wheel trades for 2024. If you wish to see them, do comment special edition down in the comment section below. Thank you.